Hey friends, Lucian here with the Bullish Bears team. This video is going to be about how to trade rising wedge patterns. Now, a rising wedge pattern is basically a bigger bear flag. So don't let the name fool you when you hear rising. Yes, price is rising, but just like on a bear flag, there is that time period where price consolidates and moves back up again. So as price is rising on a rising wedge, it is a bearish pattern. So basically you look for these rising wedges as well as falling wedges in the bigger overall patterns. So when you see these patterns, anything like bull flags, bear flags, pennants, stuff like that, you'll find them many of times inside the bigger overall falling wedges and rising wedges, right? And that's where learning how to draw trend lines and connecting those angular support and resistance levels is very important. So you find these patterns and then you find the bigger overall trend. So as you'll see here, I have a big kind of falling wedge pattern kind of drawn out. You'll see kind of a falling channel coming down here. This is just Facebook on a daily. You'll find these patterns just like any other patterns on all different chart time frames and all different stocks. But again, with these large cap stocks, you'll see larger, falling wedges, larger rising wedges. So again, that's why it's important to learn the market overall, learn the patterns, see what the market is doing overall, and then you can drill into these other large cap stocks. And again, these stocks run with the market typically. So many times you'll see, if you're looking at the SPY, you might see a big overall falling wedge or rising wedge, and then you might look at Apple and see the same thing, right? So you'll see right here kind of a falling channel right here, kind of for like the flagpole down. And then you connect these peaks out right here. So you'll see I connected, you want to get at least 2, ideally 3 or more peaks and valleys, those support resistance levels. So you'll see here connecting the bases down over in here. And so you see kind of that wedge, right? So a rising wedge pattern. So you'll see price is falling, then it kind of does a reversal and kind of moves to the upside. So the rising wedge right here. And since it's a bearish pattern, what you would do is when price fails the base of angular support of this rising wedge, this is where you would take your short position or bearish options trade. So you would take your short or bearish options trade down here, and then you would use a candlestick close above the top of this candle as your stop. Now that's just typical. Again, it all depends on what your risk management strategies are, what you're trading, whether you're doing shares or options, all that good stuff. But typically, again, if we were saying, let's say, just all things being equal, if you were just trading shares, if you took a short down here, you'd use a candlestick close above here as your stop. So again, you'll find these patterns on all different charts and time frames. Just kind of think of it overall as a bigger overall bear flag.